Thanks for downloading this episode of the Resilient Advisor Podcast. My name is Jay Coulter. The first half of 2018 presented investors with some real challenges. If you're not familiar with our resilient investing philosophy, we do not make market forecasts or predictions of any kind. We feel that forecasting is a loser's game. We simply observe the markets, look at the outcomes, and see if our systems for long-term investment performance are still working. Some things of note from the first and second quarter of this year. German banks are trading at their lowest since 1988. The Argentine Peso is off to its worst start since 2002. U.S. financial conditions have tightened the most to start a year since 2002. Systemically important banks are off to their worst start since the financial crisis. And you look at China stocks and German stocks are really struggling this year. Emerging markets, gold, silver, off to their worst start since 2013, and high-yield bonds are struggling as well. There's a lot to be concerned about. So let's take a look first at some of these major market indices. For financial advisors and investors, there were outsized returns in growth. There was pain to be found, though, if you were allocating exclusively to value stocks. For those who are old enough to have been a market participant in the late 1990s like myself, this disparity between growth and value looks familiar. If you look at the sectors in the U.S. economy, technology and consumer cyclicals drove the market's overall performance. And at this stage in the market cycle, it seems like investors would be taking an outsized risk by over-allocating to these sectors at the beginning of the year. And just as a reminder, if you're allocating to consumer cyclical sectors, that includes restaurants, apparel companies, auto parts retailers, entertainment companies, and home improvement retailers. Companies that tend to have a lot more downside when the markets do turn. Looking at the fixed income marketplace, there has been some significant pain for investors. I do think it's worth noting that the TIPS have performed as designed, being the only sub-asset class that has performed so far year to date. Over the past few months, I've had conversations with advisors about how to best allocate to the fixed income sector. None of the options are really appealing at this particular point in time if you're diligently managing a portfolio. Just looking at the structures, mutual funds really create some perverse incentives for the management team to create conflict between the investors and their own incentives. Individual bonds, really hard to find at your desk. And you also have to worry about whether you're getting a competitive bid-ask. Traditional fixed income ETFs, if you look at the performance year to date, because of the way they're structured, really have provided some pain inside the portfolios. And then I get a lot of questions about the defined maturity ETFs. While they seem to be working as designed, they still have not been through a raising interest rate environment. And you got to question whether you want to have your capital or your client's capital, if you're a financial advisor, to go through that test the first time it happens. One theme that continues to be brought to my attention by financial advisors is the concept of using dividend-paying stocks for a fixed income allocation. And this drives me crazy. When somebody suggests this, I think they've really lost their ability to think rationally about portfolio construction. A stock is not a bond. In the same way, a chicken is not a motorcycle. You're not comparing apples to apples, and you're not going to get the outcomes that you're looking for by using dividend stocks instead of fixed income in your portfolio. One item of note, if you look at the short-term interest rates on 3-month, 6-month, 9-month, and 1-year paper, there could be an opportunity right now to build short-term ladders to help protect yourself or your clients at this stage of the cycle. Shifting gears to commodities, 2018 has delivered positive performance for some commodity structures. The long-only indexes are up mid-single digits year to date. And if you're allocating to commodities to provide exposure to securities that can help protect your capital in a period of rising or high inflation, they seem to be working now. As always, be extremely cautious in the type of structure you use to get exposure to commodities. The devil is in the details, and there are a lot of very bad products in the market. The PE ratio, as of the end of the second quarter, is sitting at 24.74 if you use the as-reported PE multiple on the Schiller website. There's an old saying that there are lies, damn lies, and statistics. I think that could be reworded to say there are lies, damn lies, statistics, and PE multiples. As always, the devil's in the detail in what you're using for your earnings. Some people will go and talk about forward earnings. Some will do revised earnings. Some will do operating earnings. As long as you look at it on a consistent basis, that has the highest probability of giving you a great view into where valuations are today. On the blog post associated with this podcast, you'll see a chart of the PE ratio going back to 1880. And while we are at elevated levels today, it's very clear that there is still plenty of room for multiple expansion. There's also plenty of room for the multiples to collapse. As always, we don't forecast, but it's important to pay attention to where those multiples are. The second half of 2018 should be really fun to observe. In my experience and through research, I can tell you that a diligently allocated portfolio that is customized to track your risk tolerance and your goals is the only way to navigate these markets. If you would like to be connected with an experienced financial advisor that can help you build a custom portfolio and financial plan, let's schedule a time to talk and I'll provide you with a couple of recommendations. All the links are in the show notes. And as always, thank you for tuning in.